Warren Buffett spent 60 years picking individual stocks and beating almost everyone on the planet. Yet the investment he recommends for regular people contains zero stock picking and requires almost no skill. These are the three ETFs his own words point to, and the math behind each one. Here is what makes this conversation worth having. Most people assume that because Buffett is the greatest stock picker in history, his advice to regular investors is to learn how to pick stocks like him. What he actually says in his public writing is almost the opposite of that, and understanding why he says it changes how you think about your entire approach to building wealth. The source: Buffett's 2013 shareholder letter. The foundation of Warren Buffett's ETF philosophy comes from a specific passage in his 2013 Berkshire Hathaway annual shareholder letter, which is publicly available and widely referenced. In that letter, discussing the instructions he left for the trustee managing his wife's inheritance after his death, Buffett wrote that the advice to the trustee could not be simpler. Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. He then specified that he suggests Vanguards. He concluded by stating he believes the long-term results of this policy will be superior to those attained by most investors, whether pension funds, institutions, or individuals who employ high-fee managers. And that single paragraph is the entire framework. A percentage split and a named fund company point to three specific ETF categories, each of which maps directly to a product available to any investor in a standard brokerage account today. ETF 1, VOO, Vanguard S, and P500 ETF. Buffett named Vanguard specifically in that 2013 letter, and the modern product that directly represents that recommendation is VOO, the Vanguard S and P500 ETF. VOO tracks the S&P 500 index, holds shares in the 500 largest publicly traded U.S. companies weighted by market capitalization, and carries an expense ratio of 0.03% annually, which is among the lowest of any investment product available to retail investors. The math behind VOO spans more than a century of market history. According to data compiled by NYU Stern School of Business professor Aswath Damodaran, the S&P 500 has delivered an average annualized total return of approximately 9.8% from 1928 through 2023, including dividends reinvested. That figure accounts for every major crash in that period, including the Great Depression, the 2000 dot-com collapse, the 2008 financial crisis, and every bear market in between. Buffett reinforced this recommendation publicly through his famous 10-year bet with hedge fund firm Protégé Partners. In 2008, Buffett wagered that a simple S&P 500 index fund would outperform a curated portfolio of hedge funds over a 10-year period. He used Vanguard's S&P 500 index fund to represent his side of the bet. At the end of 2017, the S&P 500 index fund had returned approximately 7.1% annualized. The collection of hedge funds returned approximately 2.2% annualized over the same period, confirmed by both parties when Buffett won. The win validated what his Warren Buffett investment strategy has always argued, that simplicity and low costs outperform complexity and high fees over long time horizons. ETF 2, SPY-SPDRS, and P500 ETF Trust. SPY is the original S and P500 ETF, launched in 1993, and it is relevant here for a specific documented reason. Berkshire Hathaway's own portfolio, as disclosed in SEC 13F filings, includes actual positions in SPY held within its insurance subsidiary portfolios. The company Buffett has built and managed for decades holds the S&P 500 ETF structure directly, confirming that this is not a recommendation made purely for others, while Berkshire does something different internally. SPY and VOO track the identical index, and their long-term performance is functionally equivalent. The meaningful difference between them is cost. SPY carries an expense ratio of 0.0945%, while VOO sits at 0.03%. On a portfolio of $100,000 held for 20 years at a 9% average annual return, that expense ratio difference costs the SPY holder approximately $9,400 more in fees compared to VOO over the full period, based on standard compound fee drag calculations. Both are exceptional products and both represent genuine ownership of the 500 largest American businesses. The math favors VOO on long-term cost, which is precisely why Buffett named Vanguard, specifically in his letter, rather than simply saying low-cost S&P 500 fund. ETF 3, SHV, iShares Short Treasury Bond, ETF. The third component of Buffett's framework is the 10% he directed toward short-term government bonds. In modern ETF form, this allocation maps directly to products like SHV, the iShares Short Treasury Bond ETF, which holds U.S. Treasury securities with remaining maturities between 1 month and 1 year, or BIL, the SPDR Bloomberg 1 to 3 month T-bill ETF. The role of this 10% in Buffett's recommended portfolio is not to generate strong returns. It exists to provide stability, liquidity, and a behavioral buffer against the inevitable volatility of the 90% equity allocation. The Warren Buffett investment strategy embedded in this 10% is an acknowledgement that even the best long-term investment plan fails if the investor abandons it during a market downturn. The math on this allocation is about what it prevents rather than what it earns. Research published in the Journal of Finance on investor behavior during market declines shows that investors who hold a meaningful short-term bond or cash buffer are measurably less likely to sell equity positions at depressed prices during downturns, which is the single most destructive mistake available to a long-term investor. Locking in losses at the bottom of a bear market, then missing the recovery that follows, can permanently damage a portfolio in ways that take decades of compounding to repair. The Treasury Bond ETF in Buffett's framework is not designed to beat the market. It is designed to keep the investor from sabotaging the 90% that is doing the actual wealth-building work. Why the combined math works. The 90% in VOO compounding at the S&P 500's historical average of approximately 9.8% annually, protected by the 10% in SH5 providing stability and preventing emotionally driven selling, produces a combined result that structurally outperforms the vast majority of actively managed investment products over periods of 15 years or longer. The S&P SPIVA scorecard, which S&P Global publishes annually, tracking active fund performance against index benchmarks, found that for the 15-year period ending December 2023, approximately 92% of actively managed U.S. equity funds underperformed the S&P 500 index. That is the specific number behind Buffett's recommendation. He is not suggesting index funds because he cannot think of anything more sophisticated. He is recommending them because 92% of professionals with full research teams and decades of experience still cannot consistently beat what VOO delivers automatically at 0.03% per year. Warren Buffett's investment strategy for ordinary investors is not a beginner placeholder waiting to be upgraded when someone gains more knowledge. It is the conclusion he reached after 6 decades of investing, distilled into a framework that requires no research, no stock picking, no market timing, and no financial advisor to execute successfully. If this breakdown clarified what Buffett actually recommends and why the math behind it is so difficult to argue with, subscribe. Because every week we break down the investment strategies used by the most successful investors in the world and explain the numbers that make them work.